Everyone, I'm Alexis Christoforous, and this is Yahoo Finance's Midday Movers. Among the top stories on the move at this hour, more trouble in China. But for the first time in 2016, contagion has not crossed the Pacific into U.S. markets. How much farther could the Shanghai Composite drop? And so much for IPOs. After a lackluster year for companies going public in 2015, companies are increasingly doing the opposite and going private. What companies are cashing in on this new trend? And finally, for all you tweeters out there, the social media giant might grab your content to use in ads. Will this spark a Twitter revolt? We'll have more on those stories coming up. But first, a quick look at the market. And we're off to a better start than where we were this time last week. Right now, a mixed market with both the Dow and the NASDAQ in the green. NASDAQ Composite is trying to make a comeback. It is down just about 5 points right now. Joining me to discuss some of the other big stories of the day are Yahoo Finance Editor-in-Chief Andy Serwer and Mark Martiak, Vice President, Senior Wealth Strategist at Premier Financial Advisors. Thanks for being with us today. Well, not much data coming out today or this week for that matter, but we're going to talk about China in a minute. We do, though, have 7 Fed officials talking the markets up or down this week. There's an FOMC meeting, of course, at the end of this month, but a rate rise is not being priced in until the March meeting. So let me ask Andy, how much is the Fed, do you think, a factor in what we're seeing in the day-to-day in the markets right now?
Well, it's nice to take the eye off of China for the first time really this year, Alexis. And you talked about the decoupling of the U.S. market from the Chinese market. Again, a refreshing point. And so it would be interesting to see if we do start to focus on the Fed again. And remember that actually we have our own economy over here. And it's doing okay.
Yeah, that's right. Well, Mark, what's your take? I mean, do you think we're going to have to wait for the March meeting to get another rate rise?
It's possible we will get a rate rise. I think the jury's still out on that. We're going to find out very shortly. And to Andy's point earlier, everything really depends very often now, at least, for the last several days and several weeks, in fact, since August, with regard, it depends on China's growth. And there's been a downshift in their growth. And so, that's the backdrop that's playing out in the global markets.
What are some of the standouts for you so far this year? I mean, we're still early into the year, but there's already been plenty of action. So what are you looking at right now? I'm
looking at sectors, essentially. So I want to see if we continue the momentum with the sectors that have outperformed the S&P and have done well last year. Consumer services, some say consumer discretionary, not consumer staples, healthcare, biotech, technology. I'm looking to see if those sectors will continue to outperform.
We've talked about FANG a lot and whether or not we still think they have a little more room to grow. What are your thoughts as we move further into the year?
You know, FANG is a group, but it's not really a group. I mean, there's a huge difference between an Amazon and a Netflix, and there's a big difference between Facebook and Google. You have to look at these things one by one. And Amazon is sort of a category unto itself because, it has a PE of like 500, 800. It doesn't matter. You're living in Jeff Bezos' land. So I think, take a look at the fundamentals. Some of those stocks are pricey, some of them maybe not.
All right, well, stocks, we said at the top of the show, a mixed bag right now. It could be a lot worse, though, because the Shanghai Composite was down over 5% overnight. And if we look at the last 3 major market declines in China, going back to mid-2015, around that August time when we started to see things go south, we can see the S&P 500 has held its ground fairly well. Most recently, the Shanghai is down 18%, but the S&P only down 5%. And looking at this chart of the 2 markets, we can see the 2 prior declines were actually bigger than the current one. So the question on everyone's mind is how much further, Mark, could China drop and what will that effect be on U.S. stocks?
Well, I think everything, as I said, is predicated on China. There are really 2 very important points here. China is at the end of a huge, unprecedented cyclical boom. So they've built up a lot of excess capacity and excess credit in their system. That's one. The other part is interest rates, right? They tried at some point China pegged their currency to the U.S. dollar. They've stopped doing that. So when they try to control their exchange rate and their interest rates, that creates problems for China. So if we, besides the fact that it is in fact slowing down in growth, and then add another point, and that is we don't know about the macroeconomic data that we see and we hear about every day. We don't know how much of that is being controlled and adjusted or manipulated by the Chinese government.
There's not a lot of transparency, which we've talked a lot about. But to Mark's point, do you think that this smacks of desperation on the part of the Chinese government?
You know, this is uncharted territory for the Chinese government, and there's a real dichotomy between their state system and the free markets. I mean, you're talking about a state-controlled system trying to wrap its arms around the stock market, which is by definition something that can't be controlled. Right. Because if you control the stock market, it's not a stock market. And you can see, you know, we wrestle with this here in the United States, of course. How much regulation is appropriate? How much should you regulate and how much can you regulate? I mean, we obviously can't prevent cycles, Mark, and we've seen this. I mean, the Fed tried its best, and we had a terrible downturn, both in terms of the economy and the markets in 2008, 2009. The Chinese, you know, have never been there before. Right now, they are certainly not inspiring confidence.
No, and as they're learning, we're sort of the victims of that because we keep reacting
Growing
to it.
pains. Thank you very much.
Yeah, right?
That's pain.
Pain.
Well, it is bye-bye unicorn IPOs, or is it? The number of total IPOs shrank in 2015. It's expected to dwindle this year as well. And that's because the supply of new public equity capital is drying up amidst the current credit crunch. But funds are still available in the private equity market, which companies are increasingly turning to. So what's the story behind this new trend? Which companies do you see participating in this?
Well, I think when you look at sectors, certainly energy is a sector that I think private equity firms are going to take a very close look at. If you think about some of the retail, and it could be consumer staples, for example, that's another sector where I feel that private equity will look to target. Cost of capital is still very low. It's an ideal time for private equity to diversify their portfolios. And you look at the sectors that have been hardest hit, and energy comes to mind.
And also retail in the news, Kohl's possibly going private. You think that might be a good thing for investors?
Well, it's a reality, Alexis. I mean, it's here, and activist investors are, you know, at the fore right now. They are the movers and the shakers. You know, every sort of Wall Street season has, you know, kind of an in crowd. I mean, there was analysts, there were bond traders, and now the activists are the people that are really stirring the pot. And, you know, no company is immune. I mean, everything from Apple to GE to Disney. But then you look at companies that have rich real estate holdings that aren't growing. Hello, that sounds like a lot of retailers in this country. Kohl's being one of them. Macy's is another. PetSmart, Joseph Banks. You know, and how do you find growth if you've got a stagnant stock price and someone rattling the cage? Take it private. Do some magic.
Men's Warehouse had wanted to buy Joseph A. Banks, right?
Yeah,
That never really worked out.
A lot of deals. And these, you know, these Wall Street guys, all apologies here to Mark. He's not one of these bankers. But, you know, they're doing stuff, and some of it may create long-term value, and some of it may not. We know that.
And Andy's right about that. It really depends on what the target acquisition is and what happens down the road if they take the company private and then go back public. What I like to talk about with my clients is, in a very well-diversified portfolio, does the private equity asset class have a position long-term for you? Because that's what I counsel my investors, clients about. Long-term investing, patience, discipline. And if you look at private equity as an investment asset class, it really has to, you have to be very, very selective, but it does have a role.
It could have its place.
Where do you think, where do you think we are in the cycle of private equity right now?
Well, you made a good point earlier, Andy, about activist investing. I really still think if the cost of capital for borrowing it is at an all-time still historical low, and the Fed is very, very prudent about watching what they watch, interest rates, job, non-farm payroll numbers.
Which they signal they will be.
That's right. And their mandate for inflation. I still think it can be a very good opportune time for activists investing in particular. They need performance for their investors. So I think we're still, if you characterize it as what inning are we, I would say probably the 5th or 6th inning for private equity.
In terms of ways to go.
Yeah, in the cycle.
Yeah. All right. Well, we had 2 innings. What baseball?
I said a few.
Oh, a few. Okay, I'm going.
No, not 2.
Okay, gotcha. We saw Uber tap the private markets for $1 billion last October. Are the unicorns simply going to shun the IPO market because of all the rich capital available?
Well, they already have. I mean, you've never seen private companies, private growth companies in the history of our planet, our stock market, the United States, be this big. I don't care if you adjust for inflation or what. I mean, these are companies that are taking their time. There's no reason to do it. There's plenty of private money, too much private money even, you could say. And so the IPO market this year is going to be very interesting. I think it's going to be, picky and choosy.
picky and choosy.
Yes, to use
we're
the term of
coining
art.
that.
Yes.
Okay, and a new advertising scheme is underway at Twitter. The social media company is reportedly creating a product that will allow brands to use your tweets in their ad campaigns. But there is a catch, of course. According to one person familiar with this matter, Twitter will direct message the author of the tweet for permission before a brand can use it. Got all that? All right. So what's the idea? Let me come to you first, Mark, behind this move.
Well, I can look at it from a active Twitter user myself.
Right.
I have about 22,000 followers.
Oh, that's pretty good.
Yeah,
Mr.
and so
Popular.
I'm building, and as I look at it, if I am given a mandate or given an instruction or at least an advanced precursor to the fact that my tweet will be out there in the Twitterverse or Twitter universe, I might pause for a moment before I decide which 140 characters I want to express with regards to talking about a brand, for example. So I know with my broker-dealer, First Allied Securities in particular, we are not in a position, we cannot retweet or like other tweets. But that obviously I can still tweet, originate a tweet about something. So if I feel like if my tweet is being used, even if they come to me for permission, it might give me pause in the future for determining what I want to say.
This is not an endorsement. Andy, I have to say, you have a tweet out there about Starbucks.
No, so you mean about Hershey? Oh, I have a tweet about Starbucks
we've got
recently?
it right here.
Oh, recently, yeah. I got a lot of tweets out there. Okay, now, right, I was tweeting about Starbucks.
It says Starbucks is celebrating this holiday.
Now, this had to do, I remember I tweeted this. I tweeted
this
this recently because as we're getting to the Chinese New Year, the year of the monkey,
right.
That's what we're celebrating now. And so I was sort of making light of the fact that there was this controversy that Starbucks had in terms of them not celebrating Christmas because they didn't have Christmas cups.
Right.
So my tweet was like, well, they're definitely celebrating this holiday.
But what if they came to you and said, hey, Andy Serwer, can we use your tweet?
Yeah, I don't know what I would do with that. I'd have to say that, listen, I probably don't want to do that because it's tantamount to an endorsement.
Right.
I'm not endorsing Starbucks. I mean, I see this as being kind of problematic because here's the thing. The people that they want to get, which is to say maybe Mark, maybe J-Lo, maybe, George Clooney, aren't going to want to do it. And the people
Unless maybe you pay them.
Right.
Like
But the people who want to do it, they won't want, which is to say Joe Sleazebag, who just wants money. Right? So I don't think this is a marriage made in heaven. I think it's problematic. In other words, and they're going to send me a direct message. Oh, I was away for I'm not on Twitter every second of the day. Excuse me, Jack Dorsey.
Yes.
I think this is a little rough.
If there's a monetary incentive in there for the handlers and the marketers of the celebrity, and we all know who they are based on some of the people that hang around the reality television stars and the athletes and the entertainers, that might change the game.
I don't know how investors might feel about using their money that way.
And I mean, I like how you surprised me with my Starbucks tweet.
We try. We keep you on your toes there,
digging
Andy.
into my Twitter account. Wow.
And Andy,
careful.
Starbucks.
Right? Yeah.
Thanks for being with us today, guys.
Thanks.
And watch what you tweet. That's Yahoo Finance's Midday Movers for today. Post a comment below or on Facebook and Twitter. Thanks for watching. We'll see you back here tomorrow.